Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. The government shutdown entering day 3, but not slowing down a record run on Wall Street. Checking futures 30 minutes ahead of the opening bell, we've been seeing modest gains across the board. While investors normally would be digesting the September jobs report right now, it's on hold because of the government shutdown. Meanwhile, the AI trade has been helping support the market in recent days as well as this morning. NVIDIA and OpenAI both announcing partnerships overnight. And the government shutdown not showing an end in sight yet. Senate Democrats will be meeting at lunchtime before a possible fourth vote in the afternoon. As of now, it looks unlikely the Senate would vote to end the shutdown, even if the vote does happen. That means lawmakers will be heading home for the weekend, and the shutdown will extend into next week. And finally, President Trump reportedly considering a bailout for farmers. Reports say the president will provide at least $10 billion in aid to struggling farmers as they've been hit by the administration's tariff policies. The main beneficiaries of the support will likely be soybean farmers because China has completely stopped purchasing American soybeans. In terms of value, soybeans have been the single largest export to China. Let's get a check-in on stock futures. As I mentioned, we are seeing futures point to a higher open, but it is a very small one at the moment. We'll see if that changes throughout the morning. Even though we did not get the jobs report this morning, there is more economic data coming out at 10 a.m., so that could drive trading to some extent. Well, stocks are rising despite the government shutdown dragging into a third day. Investors shaking off the lack of a September jobs report this morning. Joining me now, Veronica Clark, Citi economist, Steve Sosnick, Interactive Brokers chief strategist, and Brian Jacobsen, Annex Wealth Management chief economist and strategist. Guys, on Earth 2, we would have been having this discussion at 8:30, and we would have been digesting the jobs report because it would have come out and the government would have shut down. But here we are in the actual reality where we are. We didn't get the jobs report. And so, Steve, I'll start with you. So what are we trading on then? If not that economic data, what is the current driver of what we've been seeing?
Good morning, Julie. Vibes. Just, the market has been so enamored with positive vibes. In a podcast I taped internally on Wednesday, I called it the Spider-Man market in regards to the wall of worry. We're just clambering up there. There's a certain amount of nihilism, actually, almost, that just all news is good news and no news matters. And so you can argue that by not getting this piece of news, that's one less impediment in the market, in the market's relentless rise. Whether you like that explanation or not, that does seem to be the vibe right now.
Yeah, it definitely feels like momentum is winning the day, Brian. How do you think about the fundamentals at this point behind that momentum? You've been pretty bullish when we've talked.
Yeah, I don't think it's necessarily nihilism. I think it would be more like existential dread. I mean, that's really what causes that wall of worry, right? And it is that wall of worry about, is the labor market slowing down too much where we're going to get a recession? Have we already had a recession? I think that's an important thing to remember, is that the labor market data that a lot of people have been wringing their hands over is a lagging economic indicator, where oftentimes you're going to see the economic numbers, the real activity improve. We saw some improvement in consumer spending. Second quarter GDP numbers were better than expected. And really, when it comes down to it, it's the earnings that ultimately matter for the markets. And we've had a few reports already that have looked, honestly, fairly good. So I think that as much as I love to look at the economic data, I like to look at the markets more about what is it telling me about what to expect with the economic data. And so it suggests to me that once some of these data releases are unembargoed or whatever they're going to do with them, that maybe it's going to show a bit of stability and slight improvement as we go into the end of the year.
Well, that doesn't really reflect either nihilism or existential dread here. But Veronica, let's get to you, because you really are steeped in the economic data. And at a time where we don't have the government stats, we do have other surveys, right? So what's your assessment of the jobs market in absence of having the official numbers?
Yeah, I think this is a labor market that has been gradually weakening for a while. Obviously, that got a lot more obvious in the official labor market data over the summer. What we've seen this week, we got the ADP employment report. That's never a great indicator for the official data in any given month, but it certainly showed more weakness in September. And I think that weakening trend, will just continue into the fall. We experienced this last summer and there was some stability as we got to the fall, but if this low hiring environment has been the case for a while, I don't really see reason for it to get better.
Well, I mean, what would unlock that? I mean, Veronica, in your view, what needs to change in order for the job market to improve? Because, we've had some economists suggest that the Fed cutting rates is not something necessarily that is going to feed directly through to job demand.
Yeah, I think that will help eventually. I do think that this has been a labor market that has been weakening for a while, primarily because this is still a cycle. This is still rates that are restrictive. And you're not getting that immediate drag on activity, but high rates will weigh on activity over time. And regardless, we've had very easy financial conditions. We've had equities at the highs for a while, and that hasn't prevented the labor market from weakening. So there has to be some other element here, and maybe it's that rates element. So I do think the Fed cutting can help.
So let's also talk about, Steve, when you talk about that sort of almost nothing matters in this market in terms of things that can slow it down. I mean, part of it is because we have the support of this spending cycle on AI. And I know there have been some questions recently about the sustainability and the return of that cycle. So I'm curious about your current thinking on kind of where we are and how much more we could see this fuel the rally.
Yeah, Julie, the questions have tended to come from, people who were around during the last cycle, the internet bubble, meaning old people, for lack of a better word. But the history doesn't repeat, but it often rhymes. And I'm starting to think in terms of the data center build out that we're seeing something akin to the bandwidth rollout that we saw late 99, early 2000, which ended up, we needed the bandwidth when all was said and done, but the companies that were doing it, Global Crossing, Northern Telecom, and of course, I don't want to bring up, I have to bring up Enron and WorldCom, which were actual frauds, but you ended up with all those companies being broke. And so I do think when I start to do the numbers on some of the data center build out, Oracle, it's great that they signed a $300 billion contract with OpenAI, but as of the last reading, their annualized revenues are $12 billion a year. I don't know where they're going to come up with $300 billion, probably not organically. So there's this tremendous amount of money that needs to be raised. To Veronica's point, they may say that conditions are a little bit tight out there, but right now money is being thrown around, without even regard to whether these deals are going to be profitability. Companies are getting rewarded for spending on AI without real regard to whether these are going to be long-term profitable investments, or without figuring out whether these are all feasible. So I do think we're sort of in that euphoric stage of a bull market right now when it comes to AI. And that euphoria is going to break at some point, but it could break tomorrow. It can break 6 months from now. It could break, years from now. But I do think we're in that sort of period when, and that's why I use the term nihilism, because if return on investment, if we need to borrow incredible amounts of money or equity finance incredible amounts of money without regard to returns, that sort of defines nihilism.
Brian, do you think that we're getting bubbly here, or do you share some of Steve's concerns about this sort of lack of return?
Well, I share his concerns, certainly. I'm not quite sure that we're fully all in on the euphoria phase. If you think about Sir John Templeton, his kind of framework about the bull markets, about starting on, you've got the pessimism, then skepticism, then optimism, then euphoria. We might be teetering on the euphoric part with some businesses, but we're not seeing a huge amount of the debt-fueled growth, right? It does seem like, hey, these companies that are investing in data centers are still really raking in the cash. So it's equity finance, but Yahoo Finance had a great article that I was just reading this morning about there is now some of this balance sheet, perhaps a little bit of accounting shenanigans, if you want to call it that, about creating special purpose vehicles to finance it. So I think it's more a question of where are we within that spectrum of going from optimism to euphoria. But when we look at other companies, right, think about small caps, mid caps that aren't caught up in the AI craze, I think that's where more of the opportunities are. And that's how we've been positioning portfolios is, kind of stay a little close to the exits when it comes to trying to bank on continued growth just because it's, data center builds out. Think about where you are in terms of some of the other opportunities.
And Veronica, from an economic perspective, how much, I've seen various charts over the past year about how much of GDP is now being accounted for by AI and its sort of tendrils spreading through the economy. When we've seen these kinds of shifts before in reliance on one particular industry, how does that usually play out, and how do we think it's going to play out this time?
Yeah, it usually doesn't necessarily end very well. The sign of a healthy economy is if you see really broad-based growth, and we don't exactly see that. We don't see that so much in the GDP numbers, and certainly not in the labor market data. We really have seen job growth narrowing to just a couple sectors. And yeah, we certainly saw that in the data the first half of the year, investment in computers, electronics, things like that, probably maybe some AI related. And yeah, that might stay strong, but if the labor market is loosening, I'm still very worried about the trend of consumption, which is still 70% of GDP.
Guys, thanks so much. And maybe next time we'll see you earlier for the jobs report. We'll see how it goes. Veronica, Steve, Brian, thanks a lot.
Thank you.
Julie.
Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Applied Materials, Chevron, and Cracker Barrel. First up, Applied Materials. Those shares sliding after the semiconductor equipment maker said it would take a $600 million hit to its full-year revenue because of China restrictions. AMAT is the largest U.S. maker of machinery used to manufacture semiconductors. It's faced increasingly strict rules in sales to China as part of the U.S. push to limit Beijing's development of domestic chips. The Commerce Department issued a new rule this week that widens the range of companies subject to export restrictions. According to Applied Materials, those shares down a little more than 1%. Next up is Chevron, a large fire breaking out at its Los Angeles refinery. Chevron released a statement calling it an isolated fire and said there are no injuries. Chevron didn't offer updates on the amount of damage caused and whether the blaze would affect refinery operations. According to the company website, the El Segundo refinery supplies 20% of all motor vehicle fuels and 40% of the jet fuel consumed in Southern California. It has a capacity of about 290,000 barrels a day. And finally, Cracker Barrel, the restaurant chain cutting ties with the marketing firm behind its short-lived logo change. That change, of course, sparked massive backlash, including from President Trump, and it has since switched back to its original logo. Cracker Barrel has faced stagnating growth and said last month that foot traffic at existing stores is expected to fall as much as 7% in the coming year. The company's shares are down 16% this year through Thursday's close. They are little changed this morning. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The government shutdown now in its third day, with a planned Senate vote expected to fail as lawmakers remain divided over a measure to extend federal funding. Joining me now, Maya Macguineas, Committee for a Responsible Federal Budget President. Maya, obviously, I know you are not a fan of shutdowns, but talk to me about we've been talking a lot about the economic cost. But when it comes from a budget perspective, you would think this would save the government money. But does it actually save the government money?
Yeah, it absolutely doesn't save money because what happens is you end up paying a lot of people belatedly for work they never did. So it's a huge waste of money, both in the fact that government has to spend a lot of time planning for the contingency situation and worrying about what ifs instead of doing the work they're supposed to do. And then during the shutdown, so many employees aren't working, but they do end up getting back pay. So that's a huge waste. But quite frankly, I don't think it's the lost money that's the worst situation in all of this. It's the fact that we are unable to budget. It's the fact that we are unable to govern. And budgeting has kind of become a joke. And yet the people who are laughing are going to be our enemies around the world who watch as our government struggles to do the single most basic duty there is, passing a budget.
Maya, you bring up a good point, because while there is lip service in Washington paid to the budget, right? Paid to reducing the deficit as well, paid to cutting spending. A lot of it seems more ideological than practical. Are there any sort of sincere voices on this in Congress right now?
There are sincere voices. I actually have the privilege of working with a lot of them and a number of bipartisan groups that work together on these issues, that grapple with the kinds of trade-offs, that bring in speakers to educate themselves and their colleagues. There's a lot of that. But ultimately, what happens is the power of the parties trumps the willingness to try to do these hard things. So ultimately, for instance, on the big tax bill that we just had, there were a lot of Republicans who understood that it wasn't fiscally responsible, but they went along with their party and did that. And we saw the same thing on the Democratic side a few years earlier with a number of bills that were passed that added to the deficit. So politics trumps good policy. And the unfortunate reality for the country is that fiscal responsibility doesn't make good politics because it's real policy choices. And in the end, we are going to have to raise revenue. We are going to have to reduce spending. We are going to have to find a way that voters actually reward politicians for making those choices. Right now, we are stuck in a very polarized, very fiscally reckless moment.
What is going to change, if any, or maybe it's not going to change? I mean, do you have any optimism that this logjam, not just in the current moment, but the bigger picture that you're talking about, do you have any optimism that it could change?
You know, we've seen positive moments before around the Fiscal Responsibility Act. In fact, there was $1.5 trillion in savings that came when there was a big fight over the debt ceiling. And then they finally put together a package that generated the most savings in a decade. That was a bright light. But what discourages me is I talk to so many politicians and they say, you know, it's going to take a crisis before we make these changes. And I just kind of want to pull my hair out and say, it's your job not to wait for a crisis. It's your job to avoid a crisis. And so I think we really need to see more political leadership on the issue. That is what is missing. And it does have to start with the president. Presidential leadership is what's helped us to make these changes in the past in a bipartisan environment most often. But we either need to see more leadership from Capitol Hill or more of a clamor from the public. And it's hard to have that when the remedies, taxes and spending, are not immediately easy to understand why those are good things for the economy and for our national security, even though they really are in terms of our first fiscal health.
Maya, how seriously do you take the threat from the administration that it's going to begin cutting workers instead of just furloughing them? And is that a way to approach, cutting spending as well?
I do take that threat seriously. I think this shutdown, potentially, if it lasts, could be different. We've already seen a huge expansion of executive power in terms of what they're willing to try to do and test the limits on. The acts of DOGE and other executive orders have kind of bypassed Congress in a lot of ways that are traditional and many of which may not be legal. I do not think that is the right way to go about spending, because that's getting at sort of small targeted savings that are driven more politically than they are structurally. Where are the savings? The savings that we need to find are from our retirement programs, our healthcare programs, the growing interest on the debt, and the fact that revenues are well below where they need to be to pay for our spending levels. Whenever people are focusing on sort of pennies on the dollar, you know that they're trying to avoid the big, hard choices. So certainly there are layoffs that could happen in our government that would generate savings, and there are inefficiencies that we should pursue. But be cautious of anybody who promises not to touch Social Security, Medicare, Medicaid, or taxes, because that is usually a signal that somebody's not really credibly going after the improvements we need.
Yeah, that is a good test indeed. When you talk about federal revenues, one of the things, of course, that the president has trumpeted have been tariff revenues. At the same time, and it's hard to know how seriously to take this. In an interview yesterday, he floated the idea of potential rebates to the American people tied to these tariffs. What do you make? I mean, first of all, how significant is that tariff revenue to paying all of this down? And secondly, what do you think of the rebate idea?
Yeah, so the tariffs have been a tremendous gift in terms of fiscal policy. They've generated more revenue. Our deficits are smaller than they were the previous year, month by month, once the tariff revenue has started coming in. However, because it has come from the White House and it's not congressionally been passed, there's no sense that these will be permanent. There's the risk that they will continue to be changed. There's the risk that they will be found to be illegal. And like you said, they start to become sort of a sweet pot where you start to give that money away. And you've heard so many things floated. Big rebates for farmers, many ways to give back the money, sometimes multiple times over. So the concern is that that money that's been coming in and that's helpful fiscally won't last. I would certainly bet that this is not going to be a permanent structural improvement to the budget, because the president has demonstrated he likes to use them for leverage and clearly has some interest in using that money to create other things. But in general, tariffs are good fiscally, but not so good economically. And if they're being used for foreign policy, it's sort of hard to understand what the foreign policy motivation is. So you evaluate them from a lot of different perspectives. Structurally, I am worried that we are going to start to count on that revenue and then it's going to disappear as quickly as it appeared.
Maya, always great to get your perspective. Thank you so much.
Thank you.
That does it for Morning Brief. We got Opening Bid next with Brian Sosnick.